Hello and welcome to today's SaaS webinar, Best Practices in Lifetime Value Pricing Analytics. I'm David Stevenson from SaaS. Let's meet today's presenters. Don Fenner has been involved in helping clients understand, define, and develop business intelligence and analytical solutions for more than 20 years. He formed Elite Analytical Solutions in 2003 to provide consultation and implementation services to clients seeking solutions to business intelligence and analytical initiatives. Michael Sweeney has been delivering statistical and analytical solutions to complex business issues for over 20 years. He has specialized in a variety of business applications, including various predictive modeling techniques, risk-based pricing solutions, retention, and lifetime value analysis, custom strategic analytical solutions, and more. Jay Kemp has extensive experience within the insurance industry, starting his career as an actuary and eventually landing his current position as Vice President of Product Development. He engaged with Elite Analytical Solutions to develop a statistical model within SaaS for lifetime value pricing. Ann Lanier Center combines her knowledge of business and SaaS technology to enable customers to quickly identify, understand, and solve problems that exist within their business environments. Her background includes marketing, fraud detection, financial services, and insurance. Welcome to all of you, and Don, I'm going to turn it over to you now.
Fantastic. Thank you, David. Good afternoon, everyone. This is Don Fenner, Principal, Founder of Elite Analytical Solutions. And I want to welcome you all to today's discussion on best practices in lifetime value pricing for insurance. As David mentioned, joining me today for this discussion is Elite Analytics Practice Lead for Insurance, Mike Sweeney, who has spent several years working at Progressive Insurance in the past and continues to work with other customers of ours in the insurance and retail and financial service space to develop analytical solutions such as lifetime value pricing. Also, Jay Kemp from Alpha will be speaking as well to share some of his experience and what I call real ROI in terms of the benefits, the financial benefits that were driven for his organization since we implemented lifetime value pricing about 7 years ago. So appreciate Mike and Jay's willingness to participate and sharing their experience with us today. So as we all know, in the insurance market today, it's extremely competitive, and retaining customers is so crucial to the growth of your book of business. So what we're going to talk to today is best practice that would not only fulfill a retention strategy, but also will identify longer retaining customers to target at acquisition time. So the analytical methodologies deployed in this solution consider not only the indemnity pricing, but also extend the pricing analysis to consider retention. So I will provide one slide of background on us, and then we can proceed. So Elite's analytics practice for insurance, we feel we're uniquely positioned as our focus is to bring the domain expertise and subject matter expertise in insurance and then combining that with our analytical and technical expertise. Our focus to date has really been working with small to mid and some large insurers to provide analytical and business intelligence expertise and solutions. We understand the issues that challenge small to medium-sized insurance companies in today's competitive market and really have developed a set of services to target and support that market, all the way from strategy through implementation. And last but not least, we have had a strong partnership with SaaS, as David had mentioned, going back to 2003. We are a SaaS consulting partner and a reseller. So thank you all for allowing me to introduce Elite to you, and what I would like to do at this time is to turn the discussion over to Mike Sweeney so we can get into some more detail around defining and then discussing with Jay some of the results that he's experienced in lifetime value pricing. So Mike, I will hand it over to you.
All right, thank you, Don. All right, we're here to talk about today lifetime value pricing, and we'll give you a little bit of a background and some thoughts in terms of how we feel lifetime value should be implemented within the insurance space. But to put it in a broader perspective, the conversation today really is focused toward insurance as a practice, as opposed to some other areas where lifetime value is really important in banking and retail and many other industries. But we're restricting the focus here today to be in the insurance space. But like I say, many of the things that you hear today are perfectly applicable elsewhere. The same types of concepts with some alterations are appropriate elsewhere. So first off, what is lifetime value pricing? And the way I would best describe it is in that tagline on the slide. It's a process whereby the benefits of customer retention are baked into pricing and operations, and I guess I'd say in a more optimal manner. So today, many insurance companies have initiatives as they relate to retention, and all insurance companies realize the value of a long retaining customer and want more of them. But many insurance companies today don't really handle it in an optimal manner, in my opinion, and the reason being is it's difficult, and it's a different type of an approach from the indemnity approach that the insurance industry has been in for many years. A lot of really good work has gone on in that space in indemnity in terms of making sure that the pricing is right based on the risk of that policyholder. But it really doesn't stop there. It kind of extends into what's the value of your long retaining customers versus your short retaining customers, and how do you approach that? So some insurance companies may handle it in a manner such as using retention discounts, or worrying about and pricing in expenses associated with writing the policy, that first term expense, which is really high. Those are all very good, but in my opinion, they're not optimal, and especially on the retention discount piece, because many cases that's applied, or it's almost exclusively applied to existing policyholders who maybe are going to renew already at a 95, 98% level. A question I would always have is, why would you want to introduce a retention discount to an existing policyholder under situations where they're going to likely be renewing anyway, unless there's a large shock to the rates? So that's kind of the issue that we're staying away from, is really the retention discount, and even so much basically the existing policyholders, and we're focusing most of our effort on quotes, on bringing customers in that have the attributes that you want, and then making sure that they're priced right. And that's really what the focus is of lifetime value pricing as we handle it here at Elite. That's one of the main focuses. We have other products that handle other situations, but this is the one that we really want to talk about today. And we feel that by handling retention benefits properly, a more refined pricing algorithm can be achieved. So yes, we want to handle indemnity properly because that is the most important attribute of pricing, but we feel that retention is also a very important attribute that's not being handled by indemnity-based pricing. And many of our clients want more long retaining customers because they realize that they're more profitable. And you'll hear in a moment as Jay Kemp speaks about his company and how he has used lifetime value pricing in just that particular goal. And he is a non-standard company is where he's working, so it's very important in his case if he wants to bring more of the long retaining customers. But lifetime value pricing is also really important in underwriting guidelines and knowing more about the customer, how long they're going to be with you, what's their value to you in the long run. So that's a little bit of a background of what lifetime value pricing is, and in our opinion, it's really the next logical step in the pricing process that some companies are handling, but many are not. And okay, so we go maybe to the next slide, Don, and we'll talk a little bit more about some of the detail. Why is it important? Okay, long tenure translates to more revenue and less cost to maintain. So if you've got two customers who are coming to you and you're writing policies for them, both of them are $500 cost expected in the next 6 months. So you're expected to have, risk to the company of about $500 a piece. So these two customers, all things equal, you might price them the same and charge them the same for their policy. But if one of them is likely to be with you for 10 years or more, and the other one is likely to maybe disappear after 3 to 6 months, somewhere in that space, forgetting just for a moment the cost to write the policy, which certainly you'd want to add to the short retaining customer, but just looking at it from the long-term value of those two customers, if one is going to stay 10 years and one's going to stay 3 to 6 years, all things being equal, I would want a lower price to the one that's going to stay for the long period of time, because you're going to make so much more profit, so much more profit over in the long run on that 10-year customer. And that's really what we're trying to go after here, is pricing it properly. Long retainers are really better overall customers, not only on that policy that you're pricing, but they typically have more vehicles, more cross-sell opportunities. They're just better overall customers. And I'm by no means saying that the short retaining customers aren't real good customers if they're priced right. They are. And I think Progressive is an example as a company. It really began in that space in terms of writing policies for really risky customers where nobody else wanted them. You know, maybe the Allstates and the State Farms didn't want them. Progressive took them right and built a big business. So that's good, and I don't have anything against that type of business. I think it's really important if it's priced right. But I do have an affinity toward bringing in more long retaining customers, because I do know that the value of those customers is very high in the long run. And today, I don't believe most companies are pricing them properly to bring them in, bring more of them in, and making sure that they're going to be happy and staying for a longer period of time. So advanced knowledge can help in the pricing and underwriting component. And what I mean by that is today's pricing algorithm, as everybody knows, for the most part consists of your indemnity price, and then you add on any discounts or surcharges. In profit is obviously baked into that, and then you charge the customer. But most companies are not considering how long the customer is likely to stay there, and making sure that the price is more attractive at inception for those customers who are likely to stay a long period of time. So we view that as an integral part of the pricing process to bake retention into it, along with indemnity. We feel both pieces are really important, and it's not one or the other. In our opinion, it's both. And certainly you're not going to run a business without the indemnity piece, but in our opinion, if you really want to refine it, you got to handle the retention component also. Obviously, lifetime value pricing and some of the components of that as it's built are critical pieces to many other operations within an insurance company, such as marketing campaigns, any outreach that you have to prospecting. I think you can also apply this type of thing to evaluating the agents in terms of who is bringing in those long retaining customers better than others, and it could be used for many purposes in that particular area of the insurance space. So I think overall, lifetime value pricing has a piece within any company. It's just a matter of how you would want to implement it. But we feel that it's important as a component of the entire pricing structure. So before I turn it over to, well, actually, I think at this point I will turn it over to Jay Kemp at Alpha Insurance Company, and he's going to go through some of the benefits and some of the uses of lifetime value pricing in his company and give you a little bit of a perspective from a customer's point of view as opposed to a supplier like ourselves. So, Jay, if I could, I'd like to turn it over to you at this point.
Sure, Mike. All right, well, rather than just read my slides to you, I thought I'd try to tell this a little bit more as a story. Again, I've been in non-standard auto my entire insurance career, so I've been doing this for 26 years now. And non-standard auto has some unique problems, I guess, that you have to address. One of those is that our customers don't tend to stick around a long time. when I first got to this division of Alpha, which is the non-standard division, one way to measure customer retention is if you have 100 customers on January 1st, how many of those 100 do you still have on December 31st? And when I first got to Alpha, that number was in the low 30s. And so we thought, wow, we could really transform our business if we could hold on to some of those customers that we're losing throughout the year. And we noticed some things about our when we did our analysis of a sort of univariate analysis of different rating variables like multi-car and prior insurance. We noticed that some of those we had a higher renewal rate on multi-car, for instance, on prior insurance, and so we thought, and initially it was sort of a, hey, you know what? I bet we could deepen those discounts to attract a few more of those customers and improve our retention. And sure enough, that worked to some degree initially. And we thought, you know what? I wonder if we could do this in a more rigorous manner. And I was given credit of being an actuary to start my career. I actually worked as an actuarial analyst for the first 5 years of my career. I'm not an accredited actuary. I like to joke with my actuarial friends that I speak actuary, but I'm not fluent. So I can certainly converse with actuaries and understand the concepts. And we thought, what if we could build a model that predicts, instead of predicting loss costs, what if we tried to build a model that predicted how long our people would stay with us? And we're a smaller organization, and when we implemented lifetime value concepts, we were a very small company, somewhere in the $90 million range, I think, is where we were at the time, a written premium annually. And so when I got to thinking about this, thinking about my actuarial training, in the non-standard market, we have just more price points than you can shake a stick at. I like to joke, and I think it's actually true, we have more price points to predict loss costs than there are people on the planet. I mean, that's how sophisticated and complex our algorithms have become for predicting loss costs. And yet, actuarially, we only had 2 price points for a third of the cost, and that's the expense cost. And so it seemed kind of an imbalance there. You have, hundreds of thousands of price points for loss costs, and yet only 2 on the expense side. And we thought, what if we could do a better job of predicting the actual expense that we incur with customers? And so the idea there was, and we were a small company, we really couldn't afford to go out and buy or purchase information. We thought, what if we just took the information that we already collect? Because we collect a lot of information for pricing purposes. What if we took all of that information and instead of pointing it at loss cost, what if we pointed it at retention, or a number of days retained, and tried to predict that? And what if we tried to quantify the difference in cost between a customer who stays 12 months versus a customer who stays only 1 month? And just to keep the math simple, let's say our acquisition cost is $120. Well, if someone's going to stay 12 months, then we can spread that cost out to $10 a month. But if somebody is only going to stay 1 month, which is very typical or happens quite a bit in the non-standard industry, then we have to get our entire $120 back that month. So that's a pretty big difference between $10 a month and the $120. And that's the idea here, in that we want to be able to identify who's going to stay a month and who's more likely to stay 12 months, and everybody in between. And as it turned out, there's quite a big difference in the people that are in our book. And so we started we engaged with Don and Mike at Elite, and they've been great partners for us. We didn't really have the in-house ability to do predictive modeling at the time. We're at a point now where we're getting to that point, and SAS is, by the way, a great tool for that. We think it's the best tool out there. But all that to say, when we started this journey, we were losing about 1 out of 8 customers every single month. So if we had 800 customers, we were losing 100 of them every month. And we wondered what would happen if we could do a better job with that. And so it took us about a year to get this new pricing algorithm that took into account lifetime value. And that's a little bit of a misnomer for us. I think everyone has to pick their own time frame that they're really interested in. For us, it was 1 year. We wanted to set pricing for the first year. That was the thing, and I feel like that was probably the most unique thing about the approach we were taking. I think most companies look at lifetime value and they look at more in terms of renewals. We wanted to actually size up the customer at the point of sale. We wanted to develop a model that said, that sized someone up as they walked into the agent's office or called them on the phone. We wanted to give some sort of prediction of their value to us at point of sale because in our business, in the non-standard industry, we write a lot more new business than renewals. So it's really more important that we be able to quantify the cost of new business customers. Well, another concept too that that bears mentioning, that the improvements you get in this is a lot like interest in a bank account. And if you get, which nobody really offers this kind of interest anymore, but let's say you get 10% on an account, within 7 years you'll double your money. And but that first year, getting 10% doesn't feel like a very big deal. And yet, if you stick with it, 7 years down the road, you've doubled your money, and you can really look back and say, wow, this really had an impact. And that's a lot of the way lifetime value pricing, it doesn't necessarily just wow you the first year, but over the course of, several years, it can have an amazing impact. And in fact, I use that example because it's been about 7 years since we introduced this into our pricing. And I recently did a presentation for a different group, and I had to come up with an estimate of the impact of just this one change to our algorithm has had on our business. And as I did the math, it was really pretty profound. We used to lose 1 out of 8 customers every month. Now we only lose 1 out of every 12. And that may not sound like a lot, but it's actually pretty huge. Because today, we write roughly 14,000 new apps a month in order to maintain our size. And if we write more than 14,000, then we grow. And I'm speaking in terms of policies in force. If we had not implemented lifetime concepts into our pricing, we'd have to write 21,000 new business apps instead of 14 just to maintain our size. So that 7,000 app difference now can actually go towards growth instead of just maintaining our size. And the fact of the matter is, had we never implemented these concepts into our pricing, we would be about a $175 million company today, when in fact we're actually going to be about a $260 million company this year. So I estimate that over the 7-year period, this has had about just on this year's revenue, about an $85 million impact. So that's about, that adds about another $12 million in commissions to agents. That's also something that we've been able to market to our agents that, hey, you're going to notice that our business tends to stick around longer. And the agents like that as well. The agents are they're looking to increase retention on their books. And so when they start to notice, oh, wow, my alpha book really tends to stick around, they notice that. And that becomes a longer revenue stream for them, and they see the financial impact for them. So there's benefits to everyone. There's obviously benefits for us. There's benefits to the agent. And one of the things that really motivates me as a leader, one of the things that really makes me feel good about what I do every day is I like to see my company grow, because that creates opportunities for people. It creates opportunities for people who work hard to, move up, get promotions and whatnot. And I would say just this one idea, really you can attribute about 25 to 30% of the people walking around our campus today, they owe their jobs to this idea being implemented, because we're that much larger that we're able to hire those people. And of course, with that many more people, that means that many more manager jobs, many more supervisor jobs, team lead jobs, and that makes me feel good, because that's opportunity for people who work hard and deserve the opportunity. People in our company don't have to wait for someone to die to move up. So that's exciting. It brings a certain amount of dynamism to the daily job, and it's exciting to see people rewarded for their efforts. So I would have to say, and this is just one idea that we're highlighting today. We think it was a big idea and it had a big impact on our business, but it's the concept that there's information out there dormant in your data, and it's waiting for you to mine it out and gain insight from it. All of this information, and I guess what I'd like to emphasize, everything that we used to transform our business, we already had all that information. It was just waiting for us to use it, and waiting for someone skilled like Elite and with a tool, an excellent tool like SAS, to be able to put it in the kind of format and algorithm that was going to transform our business. And that's exactly what's happened. Don?
That's fantastic, Jay. Thank you for sharing that with us. And Mike, I don't know if you had anything you wanted to interject or react to out of Jay's discussion. Otherwise, I thought
that was a very good description of what happened within his firm, and I'm really happy to hear the growth that they've achieved. And I think one of the things that Jay is really saying there, if you kind of look beneath the covers, it's more than just a loss cost. It's really the handling the expenses properly, and also pricing so that he can get those long-term customers that he was really after. And Jay, as I recall back at the beginning of this whole process, one of the things you really wanted to do is you wanted to broaden your business, as I recall, and have more long retaining business on your book, and really kind of transform that book a little bit more toward a standard business as opposed to strictly non-standard. And I think that's one of the things that we were able to achieve here. So.
Yes, you're exactly right, Mike. We were looking to get more in what we kind of refer to mid-market or standard. Frankly, non-standard is an exhausting business when you're constantly churning through customers. We wanted to be able, and we wanted to change sort of our business model too, because the companies that start to put an emphasis on retention, also the complement to that is providing better service, better systems, and I think that needs to be part of the consideration here. If that's your business model, if you're really looking to provide excellent service and excellent systems, then I think a high retention approach is very complementary to that sort of business philosophy, because we wanted to become a company that didn't just churn through customers, but that really showed some value and initiative investing in customers, and as you said, Mike, sort of attracting customers that are going to be with us longer, so that there's more dollars and incentive to treat them well and to provide excellent service and systems for them.
Yeah, very good, Jay.
Yeah.
All right, Don, if you want to jump on to the next slide, unless you have something else to say, we can kind of talk about some more summary here.
let me wrap this one up, and then we'll transition to the next one. But back to Jay's analysis here, to be able to quantify the benefit of these type of analytical solutions is extremely important as well, because a lot of times there can be pushback, especially on the agent side, and being able to circle back and then help the agents understand that, as you said, you're adding additional value, right, and you're making your product more attractive to them by showing this level of commission and also the growth of the organization. So, there's a lot that is driven out of this that were byproducts that we probably didn't even see at the very beginning, right? We kind of want to find the right pricing segments, and we wanted to find the right customers to target and bring on board. But pretty nice to see some of these additional benefits too. So thanks, Jay.
Yes, Don, and just to comment on that really quickly, one of the ways we marketed this to agents was that we were going to put our renewal discount, in a manner of speaking, at the front. Rather than waiting to see who was going to renew and give them a discount at that time, we're going to go ahead and put it at the front and give our best possible price. And agents resonated with that, and they understood that. The other thing, too, is this project, quite honestly, paid for itself in terms of months, not years. The payback was less than a year.
That's right. Very strong ROI in today's market. And, companies, organizations, there's not a tolerance of a multi-year return on investment either. So, to come back within 9 months, I think, was one of the discussions I think that we had. That's really significant, and also it's a lot easier than to come back for that next project, right? And you kind of gain confidence in the executive team, management team, in terms of deploying analytics within your environment.
That's a great point, Don. In fact, I would have to say that this, quite frankly, this was a home run for our organization, and I've always been I call myself a data evangelist. I've been someone who's tried to promote the value of information to the rest of the management team, and when we were able to put this win up on the board, it really got people's attention and really got people on board with, wow, what else can we do with analytics?
Right. It's really important in any organization that's trying to start out in establishing some type of analytical foundation or a team. You start out in this fashion where you get a win, and I think that's where our partnership also came into play. Is we were able to provide the resources, you had the vision and the desire, and then it's a lot easier than to start to build the additional analytical resources that you can kind of bring that in house, and you can start to kind of build on that success. So great points, Jay. Okay, well, let me transition this back over to Mike. I think we're going to do a brief summary for Mike, and then I think I've got one more slide after this to kind of wrap it up, and I think then we're going to turn it over to the folks at SAS.
All right, thanks, Don. Okay, in terms of just some of the summary points on lifetime value pricing, it really is it's optimizing for adjustments to the expense differences. There really is, as I said before, a second step in the pricing process that is not there in most companies today, but it's one that really needs to be considered. And another point to keep in mind, because a lot of people have questions about how about the regulatory issues and so forth. Well, if you think about it, there really is a strong argument for more equitable rates by aligning with the underlying costs. And part of the reason I say that is not only are long retaining customers advantageous to the company, but they also cost the company less than the newer or the short retaining customers, those that disappear within 6 months. And in fact, I would argue that without something like lifetime value pricing in hand, it's really the longer retaining customers, and many companies are subsidizing the short retaining customers, and that just seems backwards. It just seems like the costs ought to be dispersed properly so that long retaining customers aren't at a disadvantage, and by very definition, when they are, that means the price might be too high when you're quoting them. And if it's just too high by a little bit, you know, 10, 20, 30, $50, that could mean the difference in you landing that customer, that long retaining customer. So getting the price right at inception, I think, is a fairness issue, and I think there's a strong argument for that. And in addition to, it's a strong tool for you to really gain those customers at inception, so that those ones that are going to stay with you for a year, as in case of Alpha's goal, but even longer. Many will stay 5, 10 years.
Yeah, if I could intervene real quickly, just to give the audience my experience with this. We had a couple of states that pushed back mildly on this, mostly because they were confusing this concept with the concept of elasticity of demand type pricing concepts. And when we explained exactly what you're saying, Mike, that what we're really trying to do here is optimize and really we're trying to price everyone to the same combined ratio instead of pricing everyone to the same loss ratio. Really, that's the concept, which is really more fair. And when we explained it that way, we're in 9 states. 8 of them, you know, just basically once it was explained, rubber stamp, said this is great. We think it's great. The only state that pushed back a little bit more was Virginia. They did require us to do a little tweak on the model, but you know, it was just a tweak, and you know, it's still been successful in Virginia as well.
Thanks, Jay. Yeah, another small piece to consider is that today, I mean, if you were really to look within all of the segments in your book, you might find some segments that aren't profitable. And really what this lifetime value pricing does, it really helps to minimize any unprofitable segments. And, you know, those short retaining customers that you do write, that you continue to write, just make sure that they're profitable. And if it means raising the pricing a bit to the point where some of them don't sign, that can be okay, because you don't want to sign any customers that are not going to be profitable for you, and that's part of what we're considering here. And I think that was something that Alpha, you know, came to realize early on, is they do have to raise the pricing down on the low end of retention and lower it a bit on the higher end for very logical reasons. But that's a good thing. Maybe they won't land quite as many low retention ones, but the ones they do land are going to be profitable. And as Jay had mentioned, he's had a favorable shift over time, and that's one of the real goals here. Any companies that are, you know, non-standard in the case of Alpha, or even, you know, mid-market accounts, can always stand to get more of the long retaining customers. And there's always an opportunity to price properly across the range of retention. And underwriting is another area where the tools and some of the output of this process can be very useful in determining, you know, who you write and who you don't write, and, you know, and how you handle that with the agent channel. And the process allows for complete customization, as Jay said, with your own data. So we're not introducing proprietary data and paying subscriptions or any of that sort of thing for what we do here. What we're doing is using your data to help you run your business better and get your pricing more optimal. And it doesn't require anything beyond, data-wise, beyond what you already have and what you're already paying for. So I hope that was helpful in terms of just an explanation and a summary. And I think with Jay's comments, I think you get a pretty good perspective from the people who developed it, Don and I, and people that use it, such as Jay, who have had success and actually, you know, changed their business, you know, quite a bit by using this process. So, Don, I think at this point, unless Jay, you have any comments, I'd like to turn it back to you.
Okay. No, good summary, Mike.
Thank you.
All right. So my final slide really is just to kind of bring this home to, you know, implementation options. And this process is what we've used with all the customers we've worked with, and has been successful. And it's really kind of a two-phased implementation approach of first having this initiation and assessment phase, and before, you know, jumping in and having a customer commit to a full-blown modeling process and maybe going down the road and discovering we can't proceed, we did a kind of a first step with a checkpoint, roughly about a 3 to 4 week type of an engagement, and really come in, assess, and do some initial correlation on the model, and then really assess whether a full model, will be successful based on the data, the strength of the preliminary correlations, et cetera. And in all the projects that we've implemented, we've not had to turn back, and sometimes we had some thinner data, and sometimes we had a lot of good data, as in the case of AlphaVision. But it gives us the opportunity to sit down together and evaluate and say, yes, we're good to proceed. And then we get into the full model development, which is roughly about a 3-month process. A little deeper on the data preparation. Mike may come back and revisit some of the data, some of the variables, et cetera. And really, it's a typical modeling process from there, from development, evaluation. Then actually the output is a set of rating factors, model scoring, implementation, et cetera. So, a pretty concise process. We know what we're looking for when we come into it, and kind of guide the customer through it. In terms of options, there's a lot more options today, I think, in terms of cloud-based. If your organization doesn't have the infrastructure and you don't want to or can't implement SaaS in your environment, we can put that in a cloud environment for you and manage that license in the cloud. So really it becomes a kind of a zero footprint then within your organization, and we will help kind of guide you through the process from acquisition of data through strategy into model development. So last but not least, ongoing support. So I think we've done this with Jay and his team and other customers where we can also help with the support of the model, the refresh of the model. You want to make sure it's tuned up and it's reacting properly to the data changes in data that you have. So that's very important points there. But it was a pretty painless, I would say painless for the most part, type of implementation that yielded some good results. So unless Mike or Jay's got something at this time, that really wraps it up from my discussion. And I wanted to send this over to SAS and have them discuss a little bit more about some of the software solutions and tool sets that are utilized to develop a solution like lifetime value pricing. So I'll turn it over to you.
Thanks, Don. So, fellows, you did a great job talking about all of this. And so kind of the question is, where does SAS come in, and how can SAS help? So as we just discussed within the implementation options, there's several ways to approach the lifetime value pricing. So SAS's main foundational pillars that we work with are data, discovery, and deployment. We offer several different types of tools to manage your data, develop the models, score the models, deploy, monitor, and report on those models, as Don just stated. So we're going to take a look at 3 SAS products that can help you on the road to exploring lifetime value pricing. Our first business user-driven tool is the Microsoft add-in. So using the SAS add-in for Microsoft Office, you can easily start using the power of SAS in a familiar and easy-to-use tool. You can leverage the benefits of Excel, PowerPoint, Word, and Outlook familiarity while adding the capabilities of data exploration, statistical methods, and reporting. This takes Microsoft Office product from good to great and allows for a collaborative environment within your organization. Next slide, please. So in the recent future, we've seen the demand for visual, interactive, and intuitive dashboards. So SAS Visual Analytics gives you the capabilities to create dynamic and interactive dashboards, but it also brings you the analytical power and an easy-to-use drag-and-drop web interface. As you can see here, we provide forecasts, predictive models, geographical profiles, segments, correlation matrices, all with a click of a button and an easy-to-use visual environment. And our last tool on the last slide.
This is Don. Just interject one thing. The options on a tool like SAS Visual Analytics is it kind of addresses a couple requirements during this process. So the first off, this is it's a modeling exercise. So kind of below the waterline of getting in with the data and more of a predictive modeling deliverable. But the visualization capabilities now, both from the analytical side and post-implementation of a predictive solution, is really a nice integration, because you can then track and present and position those results to your executive team, out to your agents, et cetera. So I just wanted to kind of tie that together, based on this slide.
Yeah, thanks, Don. And if you see, kind of to that point, as Don just mentioned, we kind of peel back the layers, but while all of our software is seamlessly integrated together, SAS Enterprise Guide is the interface that sits on top of the foundational SAS tool that's been the backbone of SAS for 40 years for their statistical analytical history. So the Enterprise Guide interface provides a nice point-and-click wizard-driven tool that's meant to be able to set up repeatable process flows. This is where you really can get into, the nitty-gritty of your data discovery and deployment lifecycle. So the first thing is being able to work with your data, as Don just mentioned. So being able to combine, cleanse, aggregate, explore, and summarize your data. This also gives you those more advanced statistical algorithms with unsupervised and supervised learning. So some of those examples that we've already discussed today, so looking at correlations, so finding relationships within the data, building regression models. These regression models can either predict a value, a profit, expected revenue, or it can prevent the probability of someone, retaining someone as a customer. We've talked about clustering customers into groups to make usable and profitable segments. And this tool will kind of complete that life cycle by putting all of those findings into production. So you can implement and deploy your models by scoring or identifying your customers. And this also allows to create process flows that are repeatable, shareable, and can be automated. And so once those models are in production, as Don said, the visual analytics is a great place to monitor those. So all in all, I feel like SAS is instrumental in allowing you to leverage the data to analyze and implement lifetime value pricing for lots of different types of users to ultimately increase profit over time. And we've really only scratched the surface of the capabilities SAS can bring to your organization. So that's it from the SAS side. Anything else, Don or Jay or Mike?
Not for me.
No, I'm good also.
I think just one more comment just on how important the tool set is, along with the methodologies and the experience, is, just these three brief slides that you've shown really represent a lot of capability. And I see this, and I've seen it implemented as part of, a solution such as lifetime value. And as you said, with a lot of touch points, it can meet a lot of different needs. So from the predictive modeling type of resource to a product manager looking at impact on book of business and tracking success of the models and so forth, it really does give you an integrated suite to support a lot of different varieties of knowledge workers within the organization.
If I had anything to add, Lanier, it'd just be that not only did the success of our lifetime value pricing project, not only were we able to pay for the implementation development, but also it pays for the tools. We've had enough success that it's all easily paid for in multiples.
Fantastic. Well, thank you, Jay. I think so. I guess at this point, David, maybe back to you, and for any Q&A if people want to submit questions or have to this point. But yeah, we'll be around for Q&A.
Terrific. Thanks to all of those great presentations. Wonderful information there. As Don said, we do want to kick off Q&A, so please send in your questions. Again, we ask that you please use the Q&A panel to ensure that our panelists see your questions. And we've already got a few in the queue, so let's jump to it. The first question is, can lifetime value pricing be added on to existing pricing already in place?
And Don, if you want, I can take this one. And I would say the answer to that is an absolute yes. We do not, as part of this process, require that the core pricing module be replaced or resolved or anything of that sort. Really what we're looking for is an opportunity to apply the retention benefits on top of whatever pricing algorithm is in place. Now that said, it's certainly at the time where you're doing a revision and you're redoing the models anyway, that's a perfect time to implement lifetime value pricing because you're really pairing the two together. But regardless of whether it's at revision or if it's midstream, it does not require changes to the existing pricing structure.
I would echo that exactly. I mean, definitely you certainly add tables and steps to your rate order of calculation, but it certainly can be bolted on to what you're doing today.
Excellent. Next question we've got. Has lifetime value pricing been able to measure concrete benefits to justify further analytics?
Well, I think I would leave that question to Jay. I think in Jay's portion of the presentation, I think has mentioned benefits from his side, and I would feel more comfortable actually letting a customer actually address that issue.
Agreed.
Yeah, well, as I said, just this year, we're probably adding $85 million in revenue to our business, and since we're making about 7 cents on the dollar, that's about another $7 million in actual bottom line profits. So yeah, I mean, the success of something like lifetime value, if done well, can pay for all sorts of things. Like I said, the success of this project, paid for itself within months, but also now, allows us to buy the tools of the trade in SAS and the different things that Lanier showed you. We have all of those. And then, we can explore other questions, which also, it's like a snowball. Once you start answering questions, you just continue to add value to your analytics, dossier, so to speak.
Excellent. Next question, and I'm sure there's some variety here, but how long does it take to implement?
I think the generic answer, kind of the middle-of-the-road average, it really depends on a lot of factors too. Data is always the wild card in any type of analytical exercise. So, depending on data, so we'll throw a couple asterisks up front. Depending on the availability of data, condition of the data, and then schedules then become, the next challenge. This is an interactive process. We're doing a lot of work, but there are touch points, throughout where, we're bringing back results, and then we need the kind of a next step go ahead from the customer. So, but typically, all in all, this is, the first step being somewhere around a month, and then somewhere around a 3-month plus type of process from beginning to end. So the quick answer would be somewhere around a few months to actually from kind of first conversation and kickoff through having the final rating factors and final model delivered.
Yeah, I would echo
Very
that.
Good.
I mean,
go ahead.
My experience is Jay. My experience was that the actual model development, as Don said, was maybe around 4 months. And then, of course, we had to file it and get it approved on the 9 states that we're in. That from the beginning of conversations with Elite to, getting approval in the 9th state was probably just a little over a year.
It's great information.
And I'll say some of the decisions on that also, if I could add, really relate to where the company happens to be in terms of their cycle. And it may be that you want to delay implementation or work on it for a period of time until you can align it with a filing. So it really depends on a lot of issues.
Excellent. Are there any regulatory issues to be concerned with?
I guess I'll maybe repeat the comment I made earlier just so everyone is clear on it. we did get a little pushback when some regulators were getting mixed up between lifetime value and elasticity of demand concepts. And regulators are a little bit, they then a little leery of the elasticity of demand concept. So you have to differentiate and make sure they understand that that's not what you're doing, you know, that you're really trying to reward customers who retain longer. You're really trying to be more equitable in spreading your expenses into your price. And once they understand that, we really had no problems at all, with the exception of Virginia did require us to make a small tweak in the model, and that was really our, and we, you know, we're only in 9 states, so I can only speak for the 9 states that we're in.
Great. Let's squeeze in one more question here. What is the difference between lifetime value pricing and a retention discount?
You want to take that, Mike or Jay?
I can speak to that really quickly.
Go ahead.
The lifetime value pricing is more of a scoring mechanism, and it's a spectrum of pricing. You know, and you might have 10, 20, 30 different price points, whereas, you know, a retention discount, I think, would be, you know, just 1 or 2 price points. So I think that's the difference, in that it's more of a scoring mechanism that gives you a spectrum of pricing and not just 1 or 2 price points.
Yeah, and I'll also, if I could add on to that, Jay, many companies, a retention discount is typically applied to an existing policy, and in the case it may be that a policy, as I mentioned earlier, that might stay for 5 or 10 years, and if it's already been with you for 2 or 3 years, giving a retention discount at that point isn't really getting you much, but it is giving away money. So if you're already going to renew at 95, 98% level anyway, applying a retention discount to that type of policy is questionable.
I would echo that, Mike. I've never been a fan of renewal discounts because, to me, if somebody's happy with your price, why would you lower it? Just to emphasize, this is a new business concept. This is trying to give your best price at the point of sale rather than after the fact.
Well, very good. We're going to let that be the final word. Thanks to all of our attendees for joining us, and thanks very much to all of our presenters for their great information. Before we conclude, we do want to invite you to connect with SAS on social media, on Twitter, Facebook, YouTube, and LinkedIn. You can join and participate in the ever-growing SAS communities, which now has more than 120,000 members, and you can also read and subscribe to many of our blogs. Once again, thanks to everyone for joining us, and enjoy the rest of your day.